All right. Hello. Thank you for joining us. I'm Andy Arnold, CEO and Senior Wealth Advisor here at Centerline Wealth Advisors. This is the next episode in a series we like to call Between the Lines. We like to make it easy and we hope a little fun for you to learn about a wide range of topics. We look between the lines and dig deep on many subjects so you don't have to spend your valuable time trying to make sense of new developments. Today's session is on the new OBBB, or One Big Beautiful Bill. Some quick housekeeping first. Please put any questions or comments in the Q&A section at the bottom, and we'll be sure to get to those. Next, please don't take anything we discuss here as personalized tax advice. You should consult with your own CPA regarding your own particular circumstances, as we are completely unable to give you tax advice. We will follow up and send you a link to the recording a few days after in case you miss anything. The One Big Beautiful Bill is 1,000 pages long, so we'll be sure to wrap that up sometime here right about midnight. With me are Jeff Wood, CFP, and Jack Wilson as part of the financial planning team here at Centerline. We've been developing a lot of expertise around the OBBB, and we've been having some fun digging deep behind the scenes. So Jeff, Jack, please kick things off and help us all learn more about what's in store for us with these new developments.
Yeah, so we are excited to dive into this. Jeff and I've had some time to kind of go through this 870-page bill for some light reading. If you want us to send it to you, we can send it to you after today. But there was a lot of uncertainty this year, kind of what was going to happen to the Tax Cuts and Jobs Act from 17, if that was going to revert back to pre-levels or not. So we finally kind of got a little bit more clarification on what that's going to look like now and then going forward. So we're going to dive into a few different areas that kind of stood out to us. There's a lot of things in this bill that we could spend all day talking about, but we're just going to really dive into some key areas that we think, directly impact viewers that are on the show, watching today. So first off, let's go through the first slide here. We had some uncertainty around tax brackets. Okay. And so from the Tax Cuts and Jobs Act of 2017, these reduced tax rates, as you can see in that first chart on the left, were supposed to sunset or expire and revert back to before TCJA levels. So you can see there on the left what they potentially were going to revert back to. The 10 was going to stay the same. You were going to have the 15%, the 25%, 28, 33, 35, and then 39.6 on the top end. But now, with the One Big Beautiful Bill, those have been extended. Okay, so on the right side, the same TCJA, Tax Cuts and Jobs Act brackets that we have now are going to remain the exact same. Okay, that is also going to be permanent. And you'll see as we talk about some of these things today that permanent, we like to say, is written in pencil because these things can always be changed by Congress. Okay, but as of now, there is no sunset for the ongoing tax rates. Okay. Another thing to mention is there was a slight adjustment to the 10 and 12% bracket. And if you can see there on the picture on the right, there was a slight bump in the 10 and 12% bracket, which is ultimately a positive thing, meaning more dollars are going to be taxed at that 10 and 12% in those lower brackets, which is going to result in a slightly lower effective tax rate for most households, which is a good thing. It's not going to be a dramatic impact, but it's not going to tax high either. Okay. So those are first things we want to talk about is tax brackets. At least we have some certainty around what those are going to look like going forward. Okay. The next thing is the standard deduction. So on the bottom right there, you can see what the standard deduction is going to look like. So again, in 17, during the Tax Cuts and Job Act, we had an increase in the standard deduction. So almost doubled approximately in the standard deduction. With the One Big Beautiful Bill, these are going to be extended permanently. And we are also going to see an immediate bonus for this tax year in 2025. So for a single filer, you're going to see a $750 bump in your standard deduction. It's going to bump up to $15,750. And for a married filing jointly filer, you're going to see a $1,500 bump into your standard deduction. So just some slight changes, but at least, again, we have a little bit more certainty around what the tax rates and tax brackets are going to look like going forward. The next thing we want to talk about is the increase to the child tax credit. So the child tax credit, which is eligible for families who have a qualified dependent that's under 17 years of age, they can take advantage of these child tax credits per child. In the past, pre-TCJA, this child tax credit was actually only a $1,000 benefit. The Tax Cuts and Jobs Act of 17 increased that to 2,000, and so we've been sitting at this $2,000 range for the past 7, 8 years or now. But again, just like many other things, this was set to sunset and revert back to pre-levels. Okay. With the big beautiful bill, though, we will see a permanent increase to the child tax credit and a slight bump from $2,000 to $2,200 per child. As you can see there as well, this is going to be indexed for inflation, and that's the first time this has been done in 3 decades, and that's going to be starting in 2026. So that 2,200 is going to be indexed for inflation annually. On the right side, though, you can see how these phase outs apply. And there's many different phase outs within the tax bill. And this is something that can make these provisions a little bit tricky. Okay. And so you can see how sharp and aggressive that phase out is once you get to those income limits. So if you're a single or you're filing head of household, that phase out is going to start right at about 200,000, and you're going to be completely phased out when you get to 244,000. Basically, the formula they're using for the phase out is a $50 reduction in benefit for each $1,000 of excess income over that initial amount. So you can see there the same thing for if you're filing married, filing jointly, it's gonna start at 400,000, and you're gonna slowly, not necessarily slowly, but you're gonna aggressively phase out of that and be completely phased out at that 444,000 mark. But again, a tax credit is always a beneficial thing. That's a dollar for dollar, reduction in your overall tax bill. Okay. And again, this is per child that's 17 years or younger. So just a couple changes there to the tax brackets and the standard deduction. The next thing we're going to talk about, and there's been a lot of talk about that, which is the SALT deduction. So Jeff, how about you tell us a little bit about the changes to the SALT deduction?
Yeah, absolutely. Thanks for the intro, Jack. So moving forward here on the SALT deduction cap increase. So first and foremost, what is SALT, right? It doesn't just belong on your kitchen table. So actually what it stands for is state and local tax. So more specifically, that includes state and local income tax, but it also includes sales tax and then property tax too. So a lot of people, when they think about SALT, they think of deductions for their property tax on their home, but it actually also includes automobiles and boats as well. So maybe not as applicable in some of the landlocked states, but on the coastal cities, that matters a lot. Your choices in deduction for SALT actually are a little bit limited in that you can either choose income tax for the deduction or the sales tax. So you can't do both. Now, most people are going to choose the income tax because it's usually a little bit bigger, but I know a few shopaholics that might take a stab at the sales tax too. So the other kind of two choices that you have here is you can either take the SALT and itemize, or you can take the standard deduction. So you can't have both, unfortunately. And a lot of people do end up taking the standard deduction in a lot of cases, just due to the fact that, as Jack mentioned, it's gotten pretty high recently. So the context around this, so, it has been a pretty contentious thing due to its history. So you all might have seen in the news a flurry of proposals in June and July until it was passed. There's a couple different versions going through, passing back and forth to the Senate and the House, which kind of led to some confusion. So luckily, we're here to clarify some things in that this Big Beautiful Bill Act does give us at least some temporary clarity into the situation. So to zoom out just a little bit on that for context, the original deductions were actually unlimited for state and local tax for a really long time, up until 2017, when it got reduced to a 10,000. And that became a really wildly unpopular proposal for a lot of people. So when they came up for the next legislation, what they discussed was kind of going back and forth, and they settled on a 40,000. Now, the 40,000 cap is going to be for the next 5 years, and it's going to be inflated a little bit, just at 1%. So maybe not as high as people would like to see it, but it's better than nothing. Then at the end of that period, it goes back to the 10,000 that we had in 2017. So for a lot of people, this represents a major landscape shift for financial planning. So let's just take a look at the numbers here on the slide. First and foremost, like I mentioned, it is temporary, so 25 to 29. So they'll have to decide what they want to do for 2030 and beyond. One of the interesting facts here that I see is that the $40,000 limit applies to both single and married filing joint. And that's interesting because a lot of these tax deductions are usually you'll have one for single and then another for a single person. If you would combine those, they would equal the married filing joint deduction. In this case, the single person gets the full 40,000 without having to be married or file joint. But there's a caveat here as well. So if you're the head of the household, your limit actually is only that 20,000. So that's definitely something that you want to take into consideration. Taking a look here, I mentioned that there's some income phase outs. So if you look at the bottom part, that starts at 500,000 and then it slowly goes down from there. And while I say slowly, it's actually more like steeply goes down. So if you take a look at the top right, the SALT deduction and the modified adjusted gross income, you can see here that once you hit that cliff, it falls pretty quickly. And so that does open up some room for some kind of tax planning and just being knowledgeable and being mindful around what your income is and how you can kind of mess around with the brackets to make sure that you don't miss this great opportunity. And then this is a representation there at the bottom where it just shows you the growing 1% inflation. So what that means for our clients, it really just depends. So for our clients that are in Kentucky or an area where there's a pretty low tax burden on the statewide, it probably doesn't mean a whole lot because honestly, most Kentucky houses are not going to even hit the 10,000, let alone the 40,000. So that's really just for the top handful of houses. On the other side, if you live in a place like California, New York, it's going to be a complete game changer. So millions of people will get substantial federal tax relief in this situation. So kind of as an analogy, if you were to think about, if you go into a country club and every Friday you have a country club dinner and they give you a $10 drink value, so deduct your drink, right? You go in and have your dinner and right now it's been set at $10. Well, that's great. If you go in, you order your drink and you order a soda, well, you get your $4 knocked off, but that's really the extent of what you get. But for those of us who are in the higher tax states, like a New York or California, that would represent someone like a wine or a Scotch drinker who's going in and buying a $60 bottle of wine every time they go. And now all of a sudden they don't have to pay for 40%. So a lot of those people in those situations are absolutely have every reason to rejoice. And then moving forward here, the next big thing I know a lot of people are curious about, and it's a big one, is the senior deduction. So that is a deduction for anyone who is 65 or plus. So, you know, finally a senior discount that doesn't involve getting a smaller plate at dinner, right? And this may sound a little odd, but it's actually a bit of a historical nod to 1935. And I'm talking here about FDR and the New Deal. And that's when the Social Security safety net was actually established. So the thinking during that time was really, hey, the seniors are no longer drawing a paycheck, so they have different needs. And therefore, we need to make some specific tailored rules to help accommodate that, you know, aging population. And really the most straightforward way to accomplish this has just been a deduction. So I know there's been a lot of headlines about no taxes for Social Security and things along that line. And that is what they were trying to more or less accomplish here, but it's not quite as straightforward as that. So instead of having no taxes on Social Security, what they ended up with is a flat deduction that we'll call the senior discount. So what is the senior discount exactly? Well, that's going to be, like I mentioned at the top here, deduction for anyone 65 or above. Now, keep in mind that you do have to have a Social Security number. And if you're married, you do have to do a married file joint. It can't be for a married couple who's filing single. Effective date, so that does end at the end. So December 31st of 2028 is when it officially is set to sunset. The deduction is $6,000 per single, $12,000 for married filing joint. And then there are some income-based phase out. So just like a lot of these programs, you'll see they do tend to cut off some of these benefits once you get into a higher range of income. And you can see here, there's a few different graphs that shows you what that looks like. So just a caveat on the phase outs themselves and how they work is it is a percentage reduction. So you get a certain amount of dollars reducted in your benefit for every $1,000 that you earn in your income. So single filers is 75 to 175,000. Married file joint is 150 to 250. And then taking a look here, I know one thing people are curious about is the other benefits for seniors. So those still apply and they can still be stacked. So for instance, if you have your senior deduction, you have your standard deduction, well, you can also get that age 65 plus blind. Nothing's going to get discounted away from our seniors in that way. So what does that mean for our seniors here is really it's a clear benefit on your federal tax. It's a benefit straight from the IRS there for anyone 65 plus. On the Kentucky state level, well, Kentucky already doesn't tax Social Security. And then there's also a large portion of other retirement income. So we're thinking pension, 401k, IRA distributions. That's not taxed. Now that also has a limit. It's 31.1 right now. And then there's some additional benefits like your homestead exemption and your $40 personal tax credit as well, you'll still get. So end of the line here is that there is a double benefit for our seniors in both the federal and state taxes. So kind of to put this into play here, what this reminds me of a lot is a 100-yard dash. So if you think about paying your taxes as a 100-yard dash, for most people, they're going to take the standard deduction and that puts you already on the 20-yard line. So that gets you a good percentage of the way there. But we also realize that our seniors have already run a lot of races. And so for that reason, we say, hey, take another 5-yard step forward, go ahead and start at the 25-yard line in this case. And it's just a way of saying we appreciate your experience and now go on and enjoy your retirement. Now for the next, I'll kick it back over to Jack and we will go into the estate and gift tax exemption.
Yeah, so same thing here. This was set to expire at the end of this year, and there was a lot of, high net worth families were concerned about this, and a lot of estate planning attorneys were also concerned about this, where they were going to see if they were going to be busy or not during Christmas time, if this was going to change or if it was going to revert back. So pre-TCJA levels, this was around 6 million per person. It was indexed for inflation. So if it did revert back, it would be around 7 million, 7.2 million per person. But that was going to come into play. There's more families that have an estate around that range than there are that have the current estate exemption. So the estate exemption for this current year is around 13.9 million. That is going to remain permanent, and we're actually going to see a bonus starting next year in 2026. So starting in 2026, that is going to be a flat 15 million per individual. So 30 million for a married household. Okay, which is good. It's good to have because from an estate planning aspect, let's say, for example, you had a $20 million estate at old rolls and old levels, you'd potentially have, you'd have that 14 million exempted if we reverted back to where we were, but there would still be a $6 million estate tax. If we say 40% of that, that means, the state tax bill would be due around $2.6 million would be due 9 months from the day of death. So this ultimately has kept those high levels. So again, starting in 2026, it's going to be a flat 15 million per person, 30 million for a couple. So again, if I gave you that same example, that $20 million estate, based on these levels, you would have zero federal estate tax. Now, again, some states have their own self-estate tax that are baked into that. This is not talking about that. This is just from a federal estate tax point of view. Okay, so again, starting in 2026, it's going to be a 15 million flat per person, and that's going to continue to increase with inflation thereafter. Okay. The next thing, and we were really excited about this, was the 529 expansion. So flexibility within 529s in terms of what you can spend 529 distributions on and still be qualified tax-free distribution. So K through 12 expenses were baked into existing law, but you could only pay for private tuition, things of that nature. Now with these expansions, you're actually going to be able to cover some of the ancillary items. So as you can see there on the left side, that includes curriculum materials, textbooks, instructional materials. This includes tutoring outside the home. This could potentially include, a student who wants to take AP exams or some college admission exams, or even want to take, college classes inside their high school years. These are the type of expenses that are now covered under the new bill. Okay. As the top there, you can see as well, this K through 12 expenses used to be 10,000 a year, where you could spend 10,000 a year from your 529 to pay for those tuition. Now that's going to increase to 20,000. So K through 12 expenses, $20,000 a year from your 529 to cover a wider list and a little bit more flexibility in what it covers and what it doesn't cover. On the right side, you can also see 529s are now going to be able to cover post-secondary credential experience. Okay, so things like if you want to go to trade school and you want to get a CDL, or you want to be a carpenter, or you want to get into HVAC certification, you can now use those 529 funds to pay for those types of expenses, tuition, fees, books, exams. If there's any requiring continuing education, you can use 529 funds to now pay for those expenses. And same thing for professional license, like CFP, CB, or CPA. If you wanted to take the bar exam, those are all covered now under your 529, where you can now pull funds out tax-free to cover those expenses afterwards. All right. So there's a couple changes, and we were super excited about that again, because it makes 529s more flexible on what they can cover and what they can. All right. All right, next thing, couple additional considerations. So go ahead, Jeff, if you want to talk about some of the things that are changing, and then one new thing there.
Yeah, absolutely. So the first thing really is the energy credits. And, the long and the short of it there is that major clean energy projects just got much more expensive. So let's take a look at the details and break those down. So the first one here is on EV, so electric vehicles. They used to have a really nice federal tax credit. It was $7,500, and that is being removed. So if you're in the market to get a new EV, now's the time. That's being removed at the end of September, with nothing really planned on the horizon to supplement that. And then taking a look at the tax credits for energy efficiency and clean energy. So that's more to do with what you do with your home. So the tax credits for, you say, for instance, energy efficient windows, doors, insulation, then as well as renewable residential clean energy. So think about, people putting solar panels and stuff like that. What this really does is at the end of the year, that sunsets, and that jumps the prices up effectively of doing those things by about a third. So it's a pretty major increase in those type of investments. Now, what that means really for the country is, the old goal of encouraging companies to build factories for renewable energy sources like solar panels, things like that in the US, it's been less incentivized. And the new goal is more or less a wait and see on things like batteries, wind turbines, and solar panels. And really, it's a renewed focus on fossil fuels and nuclear. So it's a little bit of a shift in priorities for the country. And really what this makes me think of is the old clipper ships back from the 1850s that used to deliver mail. So they used to deliver the mail from New York, sail all the way around underneath the southern part of the US and back out to California in what they considered record time. And it was really great. It was considered a great technology just due to how fast the ships were. And they were heavily subsidized by the US government. Well, what happened is once the Transcontinental Railroad came along, those subsidies went away, and honestly, the Clipper mail ships went away almost overnight, or at least it seemed that. So they collapsed without the subsidy. So what we're seeing right now is that, we've built a scaffolding around the clean energy in that industry in the US, and just recently the scaffolding is being pulled down. So now it's really just a wait and see to see if that industry can be self-sufficient moving forward and what those progresses look like. On the other side here, we have something that I know everyone has probably heard about, and that's going to be the Trump accounts. So the Trump accounts are a pretty interesting proposition where they're basically the government is going to fund these accounts with $1,000 for any new child that's born in the next several years, basically during Trump's presidency. And I'll just roll through. There's a lot of different rules, restrictions, and things that really need to be broken down here. So first and foremost, there's going to be your rules before the year in which you turn 18, the beneficiary rather, and that'll allow up to $5,000 in annual direct contributions that is indexed with inflation, and it is non-deductible. So that's a really important thing to remember, that you cannot deduct those contributions to the Trump account. The contributions from employers, charities, government, those can be put in there as well. They count for the total of the 5,000. So important thing to consider is if you put money in for your child, that if you're expecting money from an outside source, you may want to reconcile those two to make sure you're not hitting the limit. But those outside sources typically can deduct that. But the limitation here, and it's a big one, is that you can only use eligible investments, which really means low fee US equity funds. And, there's going to be pros and cons to every type of investment, but this isn't exactly the same type of high quality, globally diversified portfolio that we typically want to use. So I won't say much more on that, but that's one thing to consider. There's no distributions allowed before you turn 18, so they need to stay in there. You can, however, roll into another Trump account. You could also be rolling it into an ABLE account in the year the beneficiary turns 17. So what the ABLE account really is for disability. It's a specific type of account that allows you to use that when you're dealing with a disability situation. And then you can also make contributions to other types of IRAs if allowed. So, you're thinking, hey, if you want to start your kid on a Roth really early, I know we have people that kids have their first earnings when they're teenagers and they want to put that in. That's totally fine, and this won't hamper that. Then on the other side of things is when you turn 18, there's a different set of rules. So distributions are allowed, but they're subject to early withdrawal penalties before 59 and a half. So if you think about this, after you're 18, a lot of these rules really mirror what the traditional IRA rules are. There are a couple exceptions here from the penalties, now not from the taxes, but from the penalties before 59 and a half, and that would be something like a first home purchase. There's a whole list of them that are out there. Then the next piece here, withdrawals of direct contributions tax-free, withdrawals of growth or excluded contributions taxable. So what that means basically is the money that you put in, you can go ahead and take that out tax-free, but you're still going to be taxed on any of the growth of that. And then in this case, you can use any investments allowed in an IRA. It will not be aggregated with other IRAs for distribution rules. So kind of the same thing I mentioned before. Those are two different limits. The IRA and the Trump limits do not affect each other. And then we don't 100% have clarity on this yet, but the RMD and 10-year rules are likely to apply. So, some of these things are still being fleshed out even by the government themselves. So as these things develop, we'll definitely, absorb that information, hold it abreast, and then make sure that, when we're having those conversations, we'll come out with those updates.
And that's not atypical, right, Jeff? Often when these new tax packages, legislation come out, they publish it, but then a lot of people in the industry, a lot of the CPAs start to have questions about, well, what if this, what if that? And in fact, when the Secure Act was published back in 2017, 2018, the list of questions about how to treat distributions went on for years, 4 or 5 years, 6 years before we started to get clarity. Congress has to publish it. It goes to the IRS. They get input from folks like us, and then go back and hash out the details and the questions. So this is nothing really new this time around.
Yeah, that's 100% accurate, and you can see that throughout history, and especially recent history with the more aggressive pace of some of these coming out. So the faster they come out, more likely the more questions they're going to have, and you can see that IRS will issue out letters and different types of things over the next several years regarding this. And really the purpose of that is to provide the clarity after a little bit of time has passed and people have kind of gotten to see what kind of questions they have.
Yeah.
So the overall view on this is obviously, go ahead and take the $1,000. It makes no sense to not take the 1,000. So just like we would tell you, hey, if you have a 401k and there's a match, go ahead and take that match. But at the end of the day, this is probably not going to be your number one source of trying to fund your child's future. A lot of the accounts that we have, so like Jack just mentioned the 529 plan and its incredible expansion, especially over the last several years, not just recently, has provided a lot of flexibility and better contribution limits. Honestly, just a whole lot of pros that probably outweigh most of the pros for this type of account. That being said, it still gives you a nice foundation when a child to start. The ultimate goal is, to have a little bit of a nest egg for everybody so that everybody's starting out on a good foot.
So the wisdom is collect $1,000 that the government's going to give for free for a child born starting this year, and then for the next several years. Go ahead and take the money, leave it in the account, let it grow. But whether or not you add to this same account or you would add to other accounts for the child is really where it comes in. And we're seeing more flexibility and the tax-free benefit of the 529 perhaps being a better solution than, say, continuing to fund this account.
Yeah, absolutely. I think that's a really good way to put it. Take the free money and then take advantage of, honestly, your most advantaged accounts first. Um, okay, and then a couple other things here. So a few more additional considerations, just some kind of one-off here. One of the things that I thought was interesting they added was that they restored charitable deduction for non-itemizers, but it's in a limited way. So right now, there's a 0.5% AGI floor on Schedule A, which is how a lot of people have been doing their itemization. In this case, you can actually contribute $1,000 for a single person or $2,000 if you're married, filed joint, and you're non-itemizers, and that starts next year. The caveat, though, is you can't donate appreciated stocks or a piece of art. You can't donate your time. It has to be cold, hard cash. But I know a lot of people who are very happy donating cash to a good cause and also have been missing out on the charitable deductions. So, this is a good thing to be cognizant of and take advantage of if you can. And then, of course, the qualified car loan interest. So in an effort to incentivize people to buy American made, more or less, there is up to $10,000 of a deduction that goes between 2025 to 2028 on U.S. assembled cars. So what's included in this exactly? Because it's not just cars. It's going to be cars, vans, SUVs, pickups, and motorcycles. What's not included, though, are RVs, ATVs, trailers, and importantly, pre-owned vehicles. Another interesting caveat here is that refinancing actually counts. So you can't refinance as far as if you have a car you own free and clear, you can't throw a loan on it just so you can get an interest-free loan, right? You can refinance an existing loan in this year and still take advantage of that as well. And then this last bit is a more or less comprehensive guide to the different deductions, and these are going to be above the line and below the line deductions. So really quickly, just a point of clarity, what is an above the line deduction? Above the line deduction is one that will reduce your adjusted gross income, which can increase your eligibility for tax credits. It can enhance deductibility of itemized deductions, and it could potentially put you in a lower tax bracket. So taking a look here at what was existing under the TCJA and then what's new. So existing here, we'll roll through these, and it's just a good refresher anyways to understand what credits are available to you. So first one, capital loss in excess of capital gains is $3,000. So that's the same thing we see year in and year out in financial planning, where you can deduct the $3,000 in loss. Sorry, $3,000 in gain, and then you can also carry forward. Educator expenses. So if you're a teacher, educator, $300 or $600, depending on your filing. HSA contributions. So that's one of the most powerful tax advantaged accounts you can use. It's triple tax advantage for your saving. And you can see that's in there. IRA or qualified plan contributions. So IRA, 401k, all that good stuff. Student loan interest. If you're self-employed, half of your self-employment tax, as well as self-employment health insurance cost, some moving expenses for armed forces members, and then there's some other adjustments from Schedule 1. Going to the other side, what was also existing, and these are now below the line deductions. So existing in the TCJA, you could have your standard deduction, you could have your itemized deduction, so one or the other, and then your section 199A qualified business income deduction. So that's, typically geared for pass-through, smaller type businesses. Now, what's new under the OBBBA? There is now the $6,000 deduction for seniors that we went over, as well as that charitable contribution. Then a couple other things that I think got a good amount of attention in the media that haven't been brought up as much recently. Qualified tips up to $25,000 for the next 4 years. And then qualified overtime compensation as well. So there's some limits on there. I would say they're pretty ample limits, so $25,000 on the tips. And then overtime compensation is $12,500, or if you file jointly, it's $25,000. And then, of course, we just went over the car loan interest. So a lot of new things that are coming up and a lot of existing things still to be cognizant of, just as a refresher, make sure to take advantage of as well.
Okay, great.
All right.
So I just wanted to remind everybody to enter any questions or comments you have in the Q&A box at the bottom there on your browser. And we will get to some of those. We've got a few coming in. We did want to just add one more slide here that we thought was interesting, some recent research we've been doing. We've been getting a lot of questions from clients in our reviews here about, hey, what is all this going on? We've got tariffs, we've got new tax bills, we've got some fresh data from the labor market that says jobs might be slowing. Are we due for a recession? And so we wanted to try to address that. Again, not related to the new tax bill, but all of these things are coming at us quickly. And so we thought it might make sense to show you this chart that goes back 75 years. And the real takeaway is that the big blue shark fins on the top are economic expansions in that 75-year period. And then the small red dips in between those are the recessions that have occurred along the way. So you can see on average, the US economy expands for 69 months, but contracts or has a recession for 10 months. The growth during that period, that expansion, is almost 25%. The contraction is around only 2.3%. And during the expansions, 12 million net jobs are added. During the contractions, almost 4 million jobs are lost. So our point here is not that these recessions aren't painful when you're in the middle of them, but historically speaking, they tend to be pretty short-lived. And once you come out the other side in just under a year on average, the economy starts to grow again. We start to see expansion. So while many people fear recessions and often the accompanying market drop, when you really step back and look at it, it's kind of part of the price you pay to be an investor, to invest in the economy, and to see growth of all these metrics, plus growth of your capital over a long period of time. So we just wanted to share that with you as a point of reference. And if you look, just personally living through, well, many, I guess I'm older than I think. I've lived through many of these and remember them all. But the two recent ones, the recession during COVID was very deep, but it was also very short. Before that, the Great Recession, it wasn't as deep, deeper than some of the others in the last 75 years, not as deep as COVID, but it lasted longer. And that's what made that one more painful than in history. So I always think it's just important to refer back to this to gain some sense of peace of mind when you think about the trade-offs. It's unfortunately the recessions and the downdrafts in your capital and your assets are just part of the process of investing. But hopefully you can take some comfort away with this slide. So let's go to now some of the questions. One of the ones that I think is pretty common, and I'm going to paraphrase this a little bit, but I think what they're asking is based on the age 65 plus credit, the $6,000 credit, how exactly, they wanted this to be related to Social Security and make Social Security income not taxable, but it's not really related to that. What does this give us? Like, say, if you're age 65, but you've chosen to delay your Social Security onset to full retirement age now, say 67, or if you wanted to wait until 70 to see an increase in Social Security income, what does this mean? Do you have to have Social Security turned on at 65 to get this credit? Or I think what we fear as financial planners, some people may confuse this and think, boy, if I don't turn my Social Security on at 65, I'm missing out on $6,000. I better do it right now, and maybe make a mistake and claim their Social Security benefit beforehand. So what are your thoughts on that?
Yeah, no, that's an excellent question. And I could see how that could get conflated really easily because, like I mentioned, the message was really strong that they were trying to eliminate taxes on Social Security. And so what they found was, this was a really, really large bill that had to get a lot of people to agree on a lot of things. I mean, just the one salt cap alone had an insane amount of debate. Never mind all the other things. This was one of the definite top top of mind items when they were doing this legislation. And so what they come up with was a way to try to fulfill what they had promised with a mechanism that works within the context of the bill. And so what they came up with was, more or less a short, sweet, and simple answer. And that is, if you're 65 plus, you have a social security number. It doesn't matter if you've turned on your social security or not, or any of the other factors. For the most part, you'll go ahead and you're able to take advantage of that deduction just by the benefit of being a citizen and having attained age 65. So definitely don't feel like you need to turn on your social security. That we're here to discuss any social security strategies or questions that you may have, certainly. But those two things have become decoupled, so they're no longer related to each other. So, feel confident in taking that deduction and knowing that you're not forced to make any decision that you don't want to.
So we can just let the Social Security decision be an independent decision.
That's
If we're
right.
65 plus, we still get to claim this deduction and it doesn't hurt us, and those two do not really relate. Okay, so I like that. I think that's probably a better way to handle this than to make it dependent or contingent on your Social Security filing status.
Yeah, definitely. You'll see a lot more seniors benefit, and especially for those who are looking actuarially at, deferring benefits a little bit longer, to still be able to take advantage of the deduction is definitely in the pro column.
Okay. All right. This next question, related to your comments about the potential for recessions and these tax changes, do you have any thoughts on long-term interest rates? Will they begin to come down? That's probably harder to predict in the stock market, but great question nonetheless. I think we're all going to have personal thoughts. Jeff, Jack, where are you seeing things?
Yeah. Well, shoot, I don't want to take Jack's opportunity, so go ahead.
Okay.
Yeah, that's a tough one. I think we'll know more soon what that's going to look like from a Fed standpoint. I know last week the odds of a Fed rate cut were extremely high. I think there saw it was like maybe 90% chance of a quick 25 basis point cut in the next meeting. I know with the PPI that came out, the producer price index, a little bit inflated, higher than what we would like. So I think that caused a little bit of uncertainty around again what the Fed's going to do next. Ultimately, I think the long-term approach and the goal for the Fed is to slowly start to lower rates. So I feel good about a rate cut. I wouldn't put my house on it, but ultimately, I feel pretty good about a potential rate cut in the future, and especially going into 2026. But it's ultimately going to see how inflation plays out the rest of the year and those readings. But we'll kind of see. I think we'll know more, maybe even tomorrow after Powell has his discussion at the summit.
Yeah, and I'll piggyback on that. So I know, that's a really hot topic. It is really week in and week out, and has been for a long time with the Fed and what they want to do about rates. But looking at a more longer term structure, the understanding is that the Fed doesn't really have the capability to manipulate the short term rates, the long term rates, only the short term rates, although they are related, right? The longer term rates are looking at more of the 10-year plus rates, and those are going to be the ones that the mortgage rates are more pegged to, for better or for worse. That's what it is. And there's a lot of factors that go into that. And what's happening right now is a lot of uncertainty in the market, which is making it harder than normal to predict. Not that wasn't already a Herculean task. But when you see a lot of inflation and we see the tariffs and kind of the wait and see on what that's going to happen, inflation has started to make its way through. We don't really know the full effects yet. I mean, if you have the luxury of listening to Powell speak tomorrow, he'll say the same thing. I can almost guarantee. But that being said, some of the top players are putting out projections. So we're thinking Deloitte, Goldman Sachs. They're looking at 2027. They're looking to be hovering at maybe 4.1, 4.2, and then a little bit lower as you go into 2029. But with a grain of salt, they revise these all the time. So I wouldn't take that as a given.
Yeah, and I think all this just illustrates how difficult the job at the Fed really is. Jeff, as you said, they can only directly influence short-term rates. And when they do make a change, it can sometimes take months to filter through the system. So they're having to make decisions in real time. And it would almost be like if you were sick and you took medicine, but you didn't know if it was going to help you for 6 or 9 months. It's kind of hard to know. Do I increase the dose? Do I decrease the dose? Is the medicine going to make me sick? So it's really a problematic approach. I don't know that there's a better one. And certainly because they can't directly influence those long-term rates without doing things like, quantitative manipulation, going into the market and actually buying bonds onto the Fed's balance sheet. But that's problematic for other reasons. So, if these forces of inflation continue to grow, if the tariff thing sort of takes off and it becomes a greater sticking point, that could drive inflation, that could send rates up in the long run. The argument on the other side of that is we are an aging population, and as we get older, we become less productive. The economy tends to grow at a more modest pace, and if that's the case, then it's hard for inflation to gain traction too. So I think we've all just said we don't really know where they're going. We have some educated guesses, but we're really just going to have to see in the coming months. And I think we'll just take one more question here because we've gone over time already. And this is probably going to be a little bit more personal opinion, but I think what they're asking here is, based on this new tax bill, some of this, there are probably going to be winners and losers from this. Do you have any opinion on who sort of does well with these changes and who might not do so well? I'll chime in on just a couple of thoughts. I mean, obviously, with an estate tax exemption of 15 million apiece or 30 million, people at the top end of the spectrum are very happy to see that because more of their wealth passes on without that 40% estate tax on a federal level. So that's definitely a win for that group. For the top income earners, knowing that the rates are going to stay where they are now and not jump up a couple points in a few years, that definitely benefits them. Jeff, you alluded to it earlier. We've seen for years, many of our families have made some charitable donations, a few $100s, a few $1,000s, thinking that would be a deductible item, but they were not getting any deduction because they were claiming the standard deduction. I'm really happy to see that for a family, for a household that contributes up to $2,000, it looks to us like that's going to be a deductible item again. So a lot less confusion around that. For families that want to donate more than a couple of thousand, they probably need to look at solutions that we often recommend, like donor advised funds, and that's a topic for another session. But there are some ways to address that. But this at least makes it easy. And so when somebody comes to collect for a charity near and dear to your heart, and you just write a check for $100, that as long as you keep receipts and documentation is likely going to be deductible. The expansion of the 529s, I think, is another great piece that can help families plan to educate their kids, not just through college, but also through some of the primary educational hurdles. Who it might hurt, if you're at the lower end of the income earning spectrum, and especially if tariffs become more endemic to what's going on here, these tax cuts don't really help you as much on the income side, and you might be pinched by having to pay higher prices, or what we call the tariff tax. The fact that you're paying more for these things becomes a de facto tax on your household. And so a household, the average household income, I think, is around 65,000 across the country. If that's your household income, and these goods become a lot more expensive, you may be paying that higher tax on 50% of your income. 50% of your income might go to buying groceries and these consumer goods. Versus if you have $1 million household income, you got a very substantial tax cut at the top, and you're not spending 50% of your income on these things. You might be spending 5% of your income on these things. So there could be some mismatches that happen there. We're also seeing the government is starting to reduce in order to try to reduce expenditures. It looks like they're talking about cutting back on funding programs like Medicaid, and that might also influence lower household incomes that might rely on those programs for food benefits, for insurance benefits, for medical benefits. And then lastly, my last thought on it is, if Medicaid does see these reductions for households that have not considered buying long-term care insurance, they could see after they've had to draw down some of their savings that there just might not be the benefits in those programs in the future like we've seen in the past. So if someone spends through their savings and their nest egg, we don't know what's going to happen to them if they need long-term care facilities and money's not available. So those are just some of the thoughts bouncing around in my head about how this might end up shaking out. Maybe the two of you have other thoughts.
Yeah, well, I mean, you covered a lot of ground there. I think one thing that was kind of hidden in there, and that has to do with the charitable giving or just working out of higher tax positions, really, would be the QOZ. So QOZ is something that we use for a lot of our clients to for specific situations. And what it does is the example we usually use is Nulu, right, where we had an area of the city that really needed some help, needed some capital injection into it to benefit, needed a little bit of TLC. And so what these do is they set up a way for you to get money out there and also work out of a lot of your large capital gains. So it's a win-win for one for the client, one for the people in the area. And you can see, I mean, the evidence is right there in Nulu, and look at the vibrant district that we have now. So the QOZ being extended kind of snuck in there, but it was a pleasant surprise. We're definitely really happy about that. And then the other thing I would say too is, the tax code, for better or for worse, is there, and it does depend on the user. So, if you really want to spend some time brushing up on it and learning the ins and outs of it a little bit more, you definitely increase your chances of becoming a winner versus kind of burying your head in the sand and not really knowing what's going on and kind of hoping for the best. That does increase your chances of it working against you instead of for you. So, the advice is always work with a qualified tax professional, and it's always making sure that you're informed and that you let these type of systematic things work for you when at all possible.
Yeah. And also throw out there, we're always available to meet over Zoom, meet for coffee, just kind of talk through some of these things, talk a little bit about your specific situation. Again, we won't give you specific tax advice, but help you think through some of these things and maybe frame them so that you can ask your CPA or so you can think about how these things might affect you in the long run. All right. Well, we're again over time. We appreciate everybody joining us. Didn't mean to hold you up for quite that long, but at least you get the rest of your day back, and we're not up till midnight digging through what was it, 867 pages, 867. Yeah, yeah, great.
Longer than the official Major League Baseball rule book.
Yep.
That's it. Well, that's not a good thing. All right. Well, thanks everybody for joining us, and we'll see you next time for Between the Lines. Have a good day.